Welcome to the Nichols Tax Update Podcast, issue 21-23 for June 7th, 2021. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I always acknowledge the value in preparation of this program of my subscription to Tax Notes Today, published by tax analysts, in my opinion, the preeminent source of information for tax professionals in the United States today. Given all the confusion that we're... Speaking of confusion, what's in this edition? 5 events. Payments by a finance company to acquire finance contracts are not currently deductible. Liability to pay a sales incentive is incurred when the all events test is met, not when the taxpayer makes a promise to pay a guaranteed minimum if the taxpayer's distributors reach a certain sales level. That's a condition that you have to meet. It can't be deductible until the condition is met. And then item number 3, the tax court backs the IRS. The Ninth Circuit backs the tax court. The IRS can determine unreported income by the use of indirect methods. In this case, that turns out to be a fancy term for bank deposit analysis. And then item number 4 this week, substance over form doctrine can be, and was, limited by Congress passing permissive legislation, which permitted form over substance. Finally this week, a golf course is denied a 501c3 status, as it certainly should have been, based on a fairly serious flawed application. It looks like whoever prepared the Form 1023 was not well versed in the rules for getting tax exemption. As I comment later, they might have thought about something other than 501c3, which would allow their members to take a tax deduction for contributions. I don't think anybody wanted that. Efficiencies. First, payments to acquire finance contracts are capitalized costs and are amortized intangibles, not immediately deductible. This is an undated technical advice memorandum released on June the 1st. Payments made by a captive finance company, XYZ manufacturer of let's say something that's sold at retail, of appliances for example, has a captive finance company. An XYZ manufacturer sells through independent retailers. The captive finance company buys the paper, the installment contracts, from the independent retailers. The captive finance company sought to take the position that those payments were immediately deductible. But no, capitalized costs paid to acquire an intangible, that's the right to receive future payments and service the account, are not currently deductible expenses. So they are required to be capitalized. Regulation section 1.263A-4C1 2i, that's a deep reference, lists a debt instrument as an example of an amortizable intangible. Next, an example of the all events test. This is another undated technical advice memorandum released on the same day as the first one. A taxpayer's liability to pay sales incentives to third-party distributors is incurred under the all events test, which means it creates a deductible expense of Code Section 461 in the tax year the distributors earn the incentive, not accelerated when the taxpayer promises to pay a guaranteed minimum sales incentive. If I have 10 distributors and I guarantee to pay a minimum sales incentive to all 10 distributors, can I take a current deduction for that guaranteed minimum? No, nor can you reduce your gross profit for that promise to pay that incentive. You've made an offer. the offer can only be accepted when those participating businesses sell the merchandise during the qualifying period. Economic performance under 461 could not occur until there was offer and acceptance. Don't believe me? Check it out. Internal Revenue Code section 461H2. Now the Ninth Circuit affirms a deficiency from bank deposits. This individual is in some hot water. 2005 through 2009 tax years, 5, 6, 7, 8, 9, 5 tax years. He's underreported his income. The IRS audited his returns. They had a suspicion that he wasn't reporting all of his income, and so they analyzed his bank deposits. Well, that's a specific item method that's used to reconstruct income. Francis Stephen Hayes, the Ninth Circuit, affirmed the tax court decision, found no error or abuse of discretion by the tax court, no error by the IRS. The IRS employed the specific item method to reconstruct the income. What is that specific item method, and where do we find some reference for it? Well, how about in the Internal Revenue Manual, paragraph 09005-009. The specific item method, this is an instruction to IRS auditors, IRS agents. The specific item method offers the most direct method of proving unreported income. The specific item method is the preferred method of proving income because it is the easiest to understand, include in a prosecution report, and present at trial. Additionally, the specific item of proof method is the hardest for the subject to rebut. Examples of the specific item method include a business that is not reported, some source of income that is just simply never been reported in the taxpayer's return, bank deposits, obviously, and deductions and or expenses being claimed that are false. What will the symptoms of this be? Well, if you are not reporting all of your income, there will be unexplained increases in your net worth. There will be evidence of expenditures of funds. There's no evidence of their receipt. Your bank deposits will be more than your reported income. Your life will demonstrate the use of cash when there's no source of the cash. For example, is it possible to live all year without buying anything at the grocery store? No. You're either going to use your credit card or you're going to pay cash. Where did the cash come from? Well, we took it out of the ATM machine. I see. Show me transaction by transaction, and we're good. But if you can't account for where the cash came from, then the presumption is you've got unreported income. Those are examples of the specific item method of auditing for unreported income. Form over substance had congressional approval. This has been going on for almost 2 decades. Celia Mazzei and her family used a foreign sales corporation. You may recall when we had the DISC, and then that was replaced with a FISC because the World Trade Organization came down pretty hard on the United States for subsidizing our manufacturers in foreign trade. So the FISC was, from the beginning, too good to be true. The expectation was that there would be some sort of taxable income somewhere, and that the FISC would get would receive payments and then pay dividends to its U.S. shareholders. Well, they forgot to tidy that up. So it was possible to construct your affairs in such a way that you organized a Roth IRA, and the Roth IRA could be the shareholder of the FISC from inception. So the individuals are never shareholders of the FISC. There was no requirement that the shareholders of a FISC be individuals. There was no prohibition that said a Roth IRA couldn't be a shareholder in a FISC. Most famously, this technique was used in the acquisition of Staples by a investment company in which Mitt Romney was a partner, so that all of his profits, all of his gains wound up in his Roth IRA. Well, we don't have that here, but we do have some other taxpayers who did the same thing. Now, the tax court, in a 15-4 vote, decided that you had to apply substance over form because that deal, where the Roth IRA was a shareholder of the fisc and nobody ever paid any income taxes ever, was too good to be true, and it defied the substance over form doctrine. But wait a minute. The Roth IRAs became shareholders in a series of legal transactions using the Foreign Sales Corporation, which was plainly allowed under the statute in 1988 when this transaction was done. The taxpayers continued to take advantage of this loophole for several years. The IRS audited their returns for 2002 through 2007, 2002, 3, 4, 5, 6, 7, 6 years this time, and assessed penalties for assessed excise taxes and penalties on the excise taxes. The FISC taxable income was generated through related party transactions that clearly lack meaningful economic substance. That structure now has not been available since 2000. These taxpayers took advantage of it when it was legal. They were grandfathered in the years that the IRS said they overpaid, that there was an excess contribution to their Roth IRA. There was no excess contribution because these individuals never owned the money that went into the Roth IRA. There was no payment to the individuals and then a deposit to the Roth IRA. The dividends were paid directly to the Roth IRA and therefore never were includable in the income of the individuals and could not have possibly been excess contributions to their Roth IRA. Finally this week, no 501c3 for a golf course. Nice try. IRS denied an organization's application for a 501c3 status because their primary activity was going to be operating a golf course and incidentally a banquet hall. Their members could reserve the banquet hall and could get a reserved tee time. That was about the only difference between a member and somebody that walked in off the street. If I walked in off the street and I had the money to pay the greens fee, I could play golf. If I walked in off the street and I wanted to arrange for my daughter's wedding reception and I had the money, I could reserve the meeting hall, the banquet hall. So the application didn't include a required provision for disposition of assets upon dissolution. It seems it was carelessly advised and carelessly prepared. The facility would basically be open to the public. So based on the IRS analysis and comments on the application, I doubt the organization could even have qualified for exempt status as a 501c7 social club, which if they came to me with this idea, I would have said, no, look, it looks like you're a 501c7 social club. We're not going to apply for exempt status on a Form 1023. We're going to use a Form 1024, which is the right form for the application for a 501c7. Well, that's it. That's all I know this week about what happened last week. Thank you for your participation and your support. Remember, stay safe. We're going to get through this together.